Stocks are starting to fail, which means the stage is set for a very big move. The question is if it will be up or down. And we're likely going to have a lot of volatility this week. Why? Biden drops out, endorses Kamala Harris, but the Democrats face turmoil if others seek nomination. So please remember volatility. It can happen to the upside or to the downside. But for how long? Well, potentially for a month. The DNC, or when we hear the official nominee of the Democratic Party, is in about a month. And the market's been pricing in a rematch. So, what is the fate of US stocks? Well, that's exactly what we're going to talk about. And with a week of a lot of blunders, here's another one. NVIDIA CEO sells $30.6 billion worth of stock. Whoa, Jensen, didn't even know you had that much stock. Actually, only wrong by a factor of 1,000. Kind of like CrowdStrike. It's actually 30.6 million. Nevertheless, they have been selling a lot of stock. And if you're a tech investor, whoa, it's not been an easy ride in the last week. It's been rough. So we already know that July 17th is when stocks start to fade. And we really want to be receptive to this. Why? Well, because now we're right back here in neutral. Neutral yesterday, neutral a week ago, neutral a month ago. And you're probably wondering, what do I do with all this information? Well, that's exactly what we're going to talk about today. We know that money market funds have seen a rise to a record of $6.15 trillion. So I'm wondering whether this is scared money or smart money, which is what I want to review today. If this is scared money, we're likely going to see more of the same. We're going to see more red. If we look to the heat map, we're likely going to see red everywhere. We're not going to see pockets of green. If we're seeing rotation, it means the market is healthy, and we're going to see mixed red and green. That's the easiest way for me to summarize it. We're either going to push back into greed or push back down into fear. And I have no idea what's going to happen with these headlines. So all we can do is be prepared. It's called plan the work and work the plan. So if we're feeling a little bit nervous, just watch until the end of the video, and I'll leave you with some actions at the end to make evidence-based analysis. We know that earnings are going to be in focus today. We're getting into the thick of earnings. So who reports? Well, the big dogs on Tuesday. So we got Tesla expecting a beat, and we also have Google expecting a beat. So beats are not enough, and we'll dive deeper on the streams this week into each individual company. But please remember, when we're going to get our preliminary print for Q2 GDP for the US, it's going to be higher than Q1. What does that mean? Earnings should be better. If people are spending more, companies make more. Oh, that sounds pretty simple. Yes, hopefully. But remember, guidance is the most important thing. Beating earnings is nice, but if the market is a future discount mechanism, what do they tell us the future is going to be? That'll be particularly important. Also, because we get two of the Mag 7, right? The magnificent stocks. They better be magnificent. Otherwise, we could see more red. Bank of Canada is supposed to cut on Wednesday, GDP on Thursday, and then PCE on Friday. And like we talked about, there's a lot of money sitting on the sides. Is this smart or is it scared money? We also know that we have an 82% chance we want to buy the dip this year and an 80% chance we want to buy the dip. But what we like to focus on in this channel is not just, oh, well, 80% chance, let's just follow. No, we want to see evidence-based analysis, which is exactly what I'm showing you here. There's a really important number. We have a failed breakout here, which is following QQQ. On the weekly chart, we have a bearish engulfing candle, right? It has the word bearish in it. How are you going to tell me that's bullish? Well, we're going to go through and talk about that. All right, so let's keep pushing forward here because I want to keep today's video short and sweet and simple. So now that we got through the odds, 80% chance the odds are going to be higher. Tech and most companies are likely going to beat. But the question is, do we have scared money or is this smart money? So now let's start looking at a few charts here because I think what we really want to understand is that before we break the monthly chart, we have to close the monthly candle out. And we have 1.5 weeks left. We're going to hear from Jerome Powell before as well, when the Fed decides, I believe it's on July 31st. So what happened on the daily chart? Well, we stopped going up. We lost the uptrend. And we've also broken the inside bar bear, which basically means we have a potential trend change. All right, make it simpler for me because I'm still not following. All right, here you go. Here we have our all-time high. Then we have 3 lower highs, 3 lower lows. With 3 candles, we form a pattern because we have lower highs with an S and lower lows with an S. We also close below the low of the previous candle for all 3 days. 1, 2, 3. So these are 3 pretty bearish candles. And if we take that same thinking on the 1-day chart and extrapolate that to the 1-week chart, well, we're still going up. We're in a megaphone. So yes, we have one bearish candle, but is one candle a pattern? No, it's one single candle. All right, I'm going to ask you for a huge favor. If you could please consider smashing the thumbs up or subscribing to the channel, I would greatly appreciate that. So on here, what will we need? Well, we would need at least 2 candles to prove we have a pattern here, which means we would need to see a weekly lower low next week and then close below there. Hey, the odds are pretty good. We're going to get a weekly lower low. Why? Well, by closing at or near the low of a candle, we normally get follow through. It's not a guarantee, but the odds are fairly good. So if that same thing on the 1-day chart is going to happen on the weekly, hey, we know exactly what to look for. Got to wait for Friday. Lots of earnings, lots of economic data, and probably a couple of headlines regarding this. So again, news versus the reaction to the news. That's all I care about is the reaction. So now if we have a bearish engulfing candle, and we've seen these before, we already know what to look for in the weekly. We're likely going to need to see 3 candles. But before we get those 3 candles printed, we're going to have the monthly candle close out. We only have 1.5 weeks left. And this one here is interesting because if we look at the numbers here, 551, well, we're awfully close to resistance unless we get back over it, right? 549, awfully close to 551. Support's like really far down. It's at 522. Whoa, that's like pretty far down. Yeah. So if we're going to go lower, the bears want to actually crack this chart to print a monthly lower low. For the month of July, they'd have to crank it down 25 points. So what's likely going to be easier is to break the chart going into August, which means wherever we close this month out, we want to watch that low to get taken out. And again, to make this so simple, it's easy to remember. Let's go back to the 1-day chart. We get one of these candles every day. We get one of these candles every week. We get one of these candles every month. So what this means is that we have to wait for the next candles before we get confirmation. But if we're getting a warning, do you want to wait till you have confirmation? We already knew about July 17th. We already knew if we stopped going up. We already knew we were due for downside. And now I'll tell you exactly what I'm expecting because that's why you tuned in, to be honest. So if now we have a look here, I didn't fully prepare this, so hopefully I'm not going to regret it. If we have a look here, we have a gap to fill in our 50 DMA. I want to show you a chart that looks similar here. NVIDIA, 50 DMA and a gap. Is the gap actually been filled now? 116.6. There we go. On the second day, we tagged it 116.56. So what do we have here? We have convergence of a gap, which got filled with the 50 DMA. Please note, though, we've not actually even filled the 50 DMA. And on the first test back down to fill this hole, we didn't hit it. We actually got a bounce to a lower high and then came back down, which means it actually took multiple attempts to fill the gap. Only now we filled it. And we're getting support here on the 50 DMA. If now we go back here to SPY, what do we have? Pretty big coincidence that we got the gap with the 50 DMA. So what I'll be watching for is the reaction. If we come back down and we hit either the 50 DMA or the gap, does that turn into a dead cat bounce that goes up? Or does it turn into a dead cat bounce that goes down? Because basically, if we zoom out to our weekly chart, that'll mean whether we get a weekly lower low and close below, or if we get a weekly lower low, but we actually rally back up and save it. I know that sounds so simple, but that's what I really want to remind you of. We're definitely getting a warning here on the weekly. So for investors, they want to be mindful that the monthly chart is currently at risk. This is a fail breakout. But what does a fail breakout really mean? It means we have a higher high and a higher low, but we're currently below the candle high. What does that mean? We're losing momentum to the upside, but there's not momentum to the downside yet. Why? There's no lower lows. There's no lower highs. Oh, so what do we need to do? We have to be patient. And that's exactly what I would advise you to do. With that said, if you want to subscribe and hang out with me on Monday at 9:15, great. If not, click the video on the left. And thank you very much for tuning in.